Welcome everyone to the first edition of Hot Coffee, Hot Topics. We are super thrilled to be launching this new program as an opportunity to discuss current events in real time with our clients and social media followers. When we talk to you a couple times a year or once a year in your reviews, we might be well past poignant things that happened during the year, and we're excited for the opportunity to have a platform that we can tell you what's on our mind and maybe put you at ease or make you excited or whatever the news might bring at any given time. I have Bill Urbanek, one of our wealth managers and managing partners here at SecondHalf Coach, with me today, and I'm very excited about our topic. There's been a lot going on in the world, and emotions are all over the map. The news is all over the map, and so we're gonna try to settle into some truth about the market and how it works and what's going on right now. So Bill, can you tell us a little more about the market cycle?
Sure. Let me first start by saying that it's really good to be here. Thanks for having me. And congratulations. This is something you've wanted to get started for a while, and I think it's a great thing. So I'm excited to be here to help you launch this, and excited to reach out to clients and be able to talk about these things in real time. Like you said, I think it's important. With so much noise on television and social media today, that's exactly what it is noise. And it's not informative as much as it is just increasing emotions. And so this platform is something that I'm excited about because it gives us an opportunity to get some real information out there to help people assess what's going on, as opposed to having information just kind of play at their emotions more, like what you see on social media and the news.
Exactly.
So thanks for doing this.
Sure.
As far as the market cycle goes, I mean, that's very technical question. I mean, technically there are 4 stages of the market cycle: accumulation, markup phase, distribution, and markdown phase. And that cycle can be something that happens over the course of a year. It can actually happen in the course of a day. If you're a day trader, you can see that you go through that cycle in a matter of hours. So, right now, most people would say that we're in the accumulation phase because we are in an overall bull market long term. We've experienced a correction recently in the market where it's come down, anywhere from 10 to 20%, depending on where you're looking this first 4 months. And that is seen mostly as people as the beginning of the next cycle, where it can kind of only go up from here, kind of, so to speak. Although we know that that's not guaranteed. So that's where most analysts would have us at. I would think from a investor standpoint, from your everyday client standpoint, they really see market cycle. They don't really see these technical phases of the market cycle. I think investors feel that there's really 3 types of markets. There's consistently up, consistently down, and consistently inconsistent. Okay, and I feel that from an investor standpoint, that's what you feel. And for the last few years, we've been in a pretty consistent up market. And this has been the first time since 2020 where we've had a few months of pretty rough times. And for the last few weeks, it's been up, down, up, down, up, down. So we're really experiencing that consistently inconsistent market right now. Volatility's at a high, which is typical of times where there's a lot of emotion in the market. So that's where, if I could kind of use layman's terms, I would say we're in that consistently inconsistent phase.
I like that. I have toddlers at home, and I would call them consistently inconsistent. I don't know that anyone's ever compared the market to a toddler.
I don't know if you have to be a toddler to be consistently inconsistent, but
very fair.
But that's a good way of looking at it.
Yes.
Unpredictable.
So that unpredictable roller coaster that we are riding right now, generally people think of the bull and the bear in the market. So
Sure.
If it's consistently running up, do you call that a bull market versus consistently running down as bear? Are we in one of those territories?
Yeah, consistently down would be a bear market, consistent up would be bull, and consistently inconsistent, most people call a whipsaw market, where you're just getting pulled all over the place. But there's also ways of looking at the bull and the bear too, as you can look at it from a cyclical standpoint, which is more short term, or you can look at it from a more longer term perspective. So you can be in like a short term bear situation in an overall long term bull expansion of our economy and markets.
Okay.
So that's, so it's not always one versus the other. Right now we've been in a bull market for a long time, which is we've had down market years, 2018, 2015, 2011. We're all volatile down years in the S&P. However, overall, the economy was expanding and markets were generally going up. We just had some periods where, the corrections and pullbacks turned out to be lengthier, where it ended up being a down calendar year in the market. But overall, the economy was still expanding.
So are we experiencing a correction right now?
That's the question of the day, really, and that's something that's coming up a lot in our meetings. You're hearing it a lot on TV and the news. Is this a correction or is this a bear market? And there's really three types of downturns people look at with regards to market performance. They'll look at like a pullback, which is basically a very short-term 5 to 10% decline. It happens so quick you really don't even notice it. And there's been 80 of those since the end of World War II. So there's been quite a bit. Corrections are 10 to 20% in decline, so it's a lot more noticeable. They can happen in weeks, months, usually does not stretch into the year conversation. We've had 27 of those since the end of World War II. And as far as bear markets go, we've had 11 since the end of World War II, and those are usually they go along more in line with fundamental problems that we're experiencing. There's economic indicators that point towards a contracting economy, which is shrinking instead of expanding. So the economic numbers more reflect what we're seeing in the market. When you see a correction, the market being down, but economic numbers still look good, that's usually when you get a feeling that it's just merely a correction and not that we're heading into a long drawn out bear market. Because right now the overall sentiment of corporations, the health of our corporations are good. Most corporations are reporting better than expected earnings, which is a great indicator, meaning they're making more money than they expected to be making. In fact, last year, 2021, corporations' profits grew like 35% for the year, which is the largest growth for like 3 decades.
Wow.
So corporations are doing well. Now they've done so well especially over the last couple of years, and in the recovery from the 2020 COVID-19 downturn, that you expect a little bit of a pullback / correction. That's basically the price you pay as an investor. If you're going to be in and you're making money and things are going really well, there is going to be a pullback or a correction of prices. And that's what most analysts think we're in right now. Now, with that being said, that can change. That's not a guarantee to stay like that. In fact, of the 27 corrections we've had since World War II, 5 of them have ended up turning into a bear market situation. And now that's only 5 out of 27. And there were some events that helps kind of push that correction maybe over the edge that we don't know whether that will happen now or not. But right now it does look like at a correction, it looks like we're at or near the bottom of it. So most would see this as a good buying opportunity in the right areas of the market, the right asset classes. And that's something that investors should be talking about with their financial advisors. It's a great time to review your risk tolerance and make sure you have the stomach to be an investor. Everybody has the stomach to be an investor when everything's going well.
Right.
But your risk tolerance isn't something that should change on how the market did today. It should be something that stays more concrete. So that you have the same risk tolerance whether things are going well or things are going not so well. And like I said, these types of situations are the price you pay as an investor. You can't expect to always be going up. And these are the times you kind of got to bear and work through to get back to the much sunnier days, which I hope are not too far around the corner.
Sure. I know that being newish to super focusing on the investment side of things, sometimes I feel like I'm struggling where I should be looking for my information. As you mentioned, the news is just noise. As an advisor, when you are assessing the health of the economy, to know that you're seeing, the numbers of the day plummet, but you're able to say, well, corporate earnings are up and, this is going well. The economy is actually very healthy. We're just having a bad day. Where do you do that research?
Well, we subscribe to a number of providers of research that is analytically based, fundamentals based. There are opinions, but they're analytical opinions. They're opinions based on research and trends, not necessarily, not emotions or political bias or any other type of bias that's out there. And none of that which I just mentioned, I can access through a remote control and looking at the television.
Mm-hmm.
Okay, I have nothing against TV. I love TV. However, I watch television to be entertained, not informed.
Mm-hmm.
People who watch television to be informed, I think, are being largely misinformed.
Mm-hmm.
And the news is not really the news anymore, like it was prior. It's entertainment. Mm-hmm. They're trying to get people to tune in. They make more money by getting more people tuned in. And how you get people tuned in is playing to people's negative feelings, not their positive ones. Instilling fear, anger, hate, blame, those types of things get people to tune in. Whereas, hey, everything looks good, everything's amazing, tune in at 6, mm-hmm. No one's tuning in.
Right.
And that's something that I think really, if I give advice to anybody listening, I want you to think about something for a second. I'm going to say something, I want you to ponder this thought. That the media, as you know it, whether it be social media or the news, whatever station it is you watch, I don't care which one, is really the only industry in the world that does better financially when its customers are unhappy. I want you to think about that. Every other industry in the world does better financially when the people they serve or the people they sell products to are happier with what they're experiencing. Mm-hmm. Okay? If people are happier, they come back more, they're willing to spend more on your product, they refer your product or service, et cetera, et cetera, et cetera. But the news or media, however you want to look at it, actually does better financially by upsetting people, because that gets more people to tune in, statistically proven. Mm-hmm. More ratings equal more advertising dollars equals more profit. Mm-hmm. These are for-profit companies. These are not nonprofits. Mm-hmm. These are publicly traded companies that have a responsibility to their shareholders, mm-hmm. to make as much money as they can. So when you think about an industry that is financially motivated to instill or inflame negative feelings, I want you to think about that for a second when you decide how credible it is of the information you're gathering from those sources.
Mm-hmm. If you're watching the news, and depending on where you go, it's all the way over here, it's all the way over here. Politics plays a lot into that. World events are playing a lot into that. In your tenure as an advisor, can you speak to maybe another time that kind of felt like this? I feel like people are, well, it's not like it's ever been before. These are unprecedented times. I feel like every time is an unprecedented time. Does this feel like a cycle in and of itself a little bit?
I don't know if I'd call it a cycle, more like Groundhog Day. It's interesting because politics is policy. Policy affects our lives. Policy affects how we live day to day. So it does play on our emotions. And we are in a more polarizing environment than I think we've ever been in before. There's always been partisanship. There's always been, difference in ideologies and things like that. You're always going to have that. Our country was founded on the belief that differences were good and that we should have differences. It's called checks and balances, and helps make sure that the thoughts and dreams and needs of all people are being considered. If we only have one opinion, well, if you're in that group, great. If you're not,
Right.
you're not being heard. So, but what's interesting to me though about that is that with the 24-hour news, everyone having access to the internet, everyone having the internet on their phones through apps, the media, the news just constantly being in our faces. And then with social media becoming the negative platform it has become, people are just getting inundated with this negativity. Mm-hmm. And it's increasing their emotions mm-hmm. with regards to things. What I find interesting with the politics is, having been doing this now 20 years, I've been through a variety of different presidencies, and Republican, Democrat, and there's policies that I believe are more prone to growth, that are more likely to help market performance, etc. But largely, markets have performed pretty similar overall with regards to presidents' political parties. There's even a trend that the second 2 years of a presidential cycle, being 4 years, largely outperforms the first 2 years of a cycle by a large margin. I mean, dating back to like 1947 to 2011, years 1, 2, and 4 yielded about a 300% cumulative return in the market.
Wow.
Where year 3 alone, during that same time period, was about 2,100%. Great, outperforming really the other 3 years combined. Mm-hmm. Now that trend has been true only about half the time over the last 4 administrations. So trends are a trend until they trend another way.
Right.
Okay.
Right.
So, there are historical things we can look at as part of our research, but unfortunately, they're not a crystal ball any more than anything else is.
Right. Right. Things are predictable until they're not predictable.
Well, they're predictably unpredictable is really the best way to look at it.
Consistently inconsistent. Mm-hmm. Coming full circle here.
Yeah.
Inflation is another word that seems to be a buzzword right now. Mm-hmm. I think that's a very real thing. What are some ways that portfolio managers can hedge against inflation?
Well, let me first say that inflation is a concern right now, and it's a concern for the first time in a long time. Mm-hmm. Inflation has been in check really since the 80s. We haven't really had too much of a problem. There have been some instances where there were short-term spikes and it was addressed, but it hasn't really been as big of a concern for quite a while. Now, with that being said, the inflation concerns, for the most part, have been what was considered transitory, which means maybe not permanent, such as more likely due to some other circumstance that's going to be worked out and prices will change, such as maybe the oil prices spiking because of the conflict with Russia and Ukraine. That's saying that the spike is mostly due to that as opposed to something that we're likely to see stick for a long period of time. Okay. Or that the price of goods are up because of lack of supply, because of supply chain disruptions, because of COVID-19 and lack of workforce in certain industries. So it was considered mostly transitory and they thought would work itself out. It has not worked itself out like the Fed has hoped. And it's now considered to be a little bit more of a real inflation. Most analysts think we've seen the peak of the inflation spike, meaning that the prices as they've got to are not likely to go much further from here in the short term. Mm-hmm. That we're probably seeing the worst of this, and the Fed is raising interest rates. Like they have recently, and they're expected to continue doing so for the rest of this year and into 2023 as a way to kind of wrap inflation and try to get it under control before it would get too high. Mm-hmm. And be something that would be more devastating. So that's something we're going to be watching closely and watching the Chairman Powell and and what the Fed Reserve does each meeting to decide, what they've got to do interest rate wise to keep this inflation in check. So.
Do you have any other thoughts about where we're going, or what this year looks like?
Well, this year I think is, I think this year is going to look similar to what we saw in 18, 15, and 2011, where things are pretty volatile. In 2011, like the stock market that year, the S&P 500 changed, like went up or down from its peak to its low, like 9%, something like 18 times in a year. That it went either 9% up from its low or 9% down from its peak. I mean, it was really all over the place. And largely that's, indicative of times where it doesn't know where to go. It's waiting to see where the resolution of some issues or some legislation that's being considered, whether that be tax increases or something. Those types of things can cause that consistently inconsistent market. So I think but there is hope, and a lot of analysts and economists still see the economy as expanding and healthy. We're still adding jobs. There are still areas of the economy that are not fully operational, still being held back from COVID restrictions. We're still looking there's certain areas that are still in need of workers. Semiconductor chips are something we're desperately in need of, which is holding up production of automobiles and other types of things. So there's a pent-up demand for these things that once the supply meets, that demand should be there and continue to give legs to this economy. And because our economy is continuing to expand, there's reason to believe that this year can still finish as a positive market year. I wouldn't expect something, to be, double digits, but I think a modest single digit gain for this year is reasonable to expect, but certainly not guaranteed. Like I said, there have been times where corrections have turned into bear markets. A lot can change with the rising, as the Fed raises these interest rates. They're hoping to do what's called a soft landing, which is kind of, bring inflation in check without putting the brakes on the economy too much. It's a delicate balancing act. So most are hoping for them to do just that. There is a possibility that they can overreach in too aggressive of attempts to slow inflation could actually slow the economy too much and therefore lead into recession. But that's not, most people are thinking that's going to be avoided. So, but that's what makes this interesting, is there's no way to tell till we go through it. I will say again though that, that investing is a relationship, and it should be a long-term relationship. It should be one that like any relationship in your life, you expect ups and downs, times that are more exciting than others, times that are more frustrating than others, times where you're not quite sure what's going on, and times that have outside influences, and that's what, we're going through right now. We've got a spike in prices. We've got a market correction. We've got a conflict between Russia and Ukraine. We've got, unrest in politics. We haven't had a high approval rating for a president in a long time. And I would count the current president and the past president in that to show that that's not a political statement, but confidence in government, confidence in leadership, I think goes a long way to people feeling more confident about putting their money out there and getting it to work for them. So I think more confidence in our government and the direction and its ability to get things done would be helpful.
Yeah.
So one can hope that we start to see some bipartisan efforts to get some things done for the American people that could get them excited about these next few years of the American economy, which they really should be.
Yeah. Thank you. Thank you very much for all your insight today, Bill. That wraps up the questions that we have for today. I hope that you enjoyed our chat. Do you have any final remarks for our audience today?
Go Pens.
There you
Playoffs
have
are
it.
starting soon.
I love it. And welcome springtime, summertime. Hopefully all of the snow is behind us. We'll see. But until
Better
next
knock on
time.
wood.
Yeah, all the wood. So we are hoping to hop on, as we mentioned, as the current events are rolling in and we have things to say. But we have our next scheduled Hot Coffee, Hot Topics for sure coming to you in July. If you have any topics that are on your mind or questions that you would like us to address, please email them to me at Bree at shcwealthmanagement.com. You can send us a private message on social media, and we'll look forward to talking to you next time. Thanks so much.